Have you ever wondered if some of the money you get is, well, invisible to the IRS? It sounds a little crazy, right? But it's true. Today, we're going to dive deep into the world of non-taxable income for 2025 and find all the ways you can legally keep more of your own cash. So just think about it for a second. Every single dollar that hits your bank account, is it all fair game for taxes? I'm willing to bet the answer is a big no, and figuring out exactly why could honestly save you a ton of money. You know, this is one of the biggest misconceptions out there. People see a deposit and immediately think, well, there goes a chunk for taxes. But that's just not how it works. There are actually a whole bunch of ways money can come to you that are completely tax-free, and we're about to go through them. All right, so let's start with the basics, right? The big life events that often have money attached. These are kind of the foundational classic rules that everyone really should know. Think about some of those huge financial moments. Maybe your parents give you a generous gift to help with the down payment on a house. That's tax-free. Or you receive an inheritance from a loved one. Guess what? Also tax-free. Same goes for any child support payments you receive, public assistance, and even the interest you earn from certain kinds of municipal bonds. Okay, now here's where we gotta pay really close attention. Getting a settlement for an injury might seem straightforward, but for the IRS, the type of injury makes all the difference. The details are absolutely crucial here. So the IRS draws a very, very clear line in the sand. If you get a settlement because of a physical injury, let's say from a car accident, that money is tax-free. But if that settlement is only for emotional distress with no physical injury involved, then it's considered taxable income. It really all boils down to the nature of the harm. But hey, non-taxable income isn't just for these huge life events. It's actually hiding in plain sight in your everyday finances, from student aid all the way to your employee benefits. So for all you students out there, this one is huge. Getting a scholarship feels like you've won the lottery, right? But the IRS has a specific rule. It's only tax-free if you use it for qualified expenses. We're talking tuition and fees that are required to attend. Let's break it down. So you get an amazing $20,000 scholarship. You use $15,000 of it for your tuition and required books. That part? Totally tax-free. But if you use that other $5,000 for your dorm and meal plan, well, you're going to have to report that as taxable income. And you know what? Your job can also be a gold mine for tax-free income. I like to call these invisible raises. When your company pays for your health insurance, that is a massive benefit that you don't pay a single cent of tax on. Same goes for things like tuition assistance, help with dependent care, and even some life insurance coverage. Okay, let's get to the really exciting stuff. Some brand new changes coming in 2025. There's a new law called the Opening Bipartisan Borders to Business Act, or OBBB Act for short. And it's creating some temporary tax breaks that are going to make a huge difference for a lot of workers. This is a really big deal, folks. This OBB Act is fresh legislation designed to give the economy a little boost, and it's doing that with some temporary tax breaks for tipped employees and hourly workers. Now, keep in mind, these rules are only on the books from 2025 to 2028, so it's super important to understand how they work right now. So, first up is something called the Qualified Tip Deduction. This is pretty awesome. It allows workers in certain service jobs to deduct up to $25,000 in tips from their taxable income. What does that mean? It basically makes a huge chunk of their tips tax-free. So how does this actually work in the real world? Let's take Chloe, a hairdresser. She has a great year and earns $15,000 in tips. Now, she still has to report all of that as income, but then a brand new special deduction comes into play that just cancels that amount right out. So at the end of the day, she pays zero income tax on those tips. Now, the second big change has to do with overtime. But you gotta listen closely here, because it's not the entire overtime check that gets the break. The law is really specific. It only targets what's called the premium part of your overtime pay. Let's look at an example to make this crystal clear. Say Jack's regular pay is $20 an hour. When he works overtime, he gets paid $30 an hour. That extra $10, that's what the IRS calls the premium. And because of this new law, Jack can deduct that $10 premium for every single hour of overtime he works. That can add up and lower his tax bill in a big way. Okay, let's move on to our final topic. And seriously, for anyone with student loans, this is a big one. There is a major deadline coming up that could have a massive impact on your taxes. So, as the law stands right now, if you get some of your student loan debt forgiven, it is generally not considered taxable income. This is a huge relief for millions of people. But, and this is a big but, this rule is not permanent. It has a sunset date. It's set to expire. This timeline shows you exactly why this is so incredibly urgent. If you get $40,000 of student debt wiped away on December 31st, 2025, your federal tax bill on that forgiveness is zero, a big fat nothing. But if this law isn't extended and that same 40 grand is forgiven just one day later, January 1st, 2026, the IRS could treat it as income. You could be looking at a truly shocking tax bill out of nowhere. Whew, okay, we've covered a ton of ground today, from the classic tax rules we all know to some major new changes on the horizon. Let's do a super quick review of the most important points to make sure it all sticks. All right, let's do a rapid fire round. An inheritance from your uncle? Nope, not taxable. That winning lottery ticket? Oh yeah, definitely taxable. The new overtime premium deduction starting in 2025? Not taxable because it's deductible. Scholarship money for your dorm room? Yep, that's taxable. And a settlement for physical injury? Nope, not taxable. Just knowing these little distinctions is absolutely key.